You know, usually when you watch a dominant gold medal sprinter line up at the blocks, there's this profound expectation of inevitability.
Oh, absolutely.
Like, it almost feels like physics, right? The starting gun goes off, they explode forward, and everyone else on the track is immediately just competing for second place.
Yeah, we really condition ourselves to view champions as untouchable, like they're operating on this frequency that the rest of the market simply cannot tune into.
Right. But then you tune into a specific race, and suddenly that sprinter is just stumbling. I mean, their form is completely broken. They're looking around nervously at the competition, and
And you're just sitting there in shock.
exactly. We are forced to look at a performance landscape that is genuinely shocking. So, welcome to today's deep dive, where we are going to examine a dynasty that is visibly stumbling right now.
And we really have a massive stack of sources to go through today.
We do. We're talking comprehensive equity research reports, Wall Street analyst downgrades, historical earnings data, and even some real-time competitor guidance.
All of it detailing the current, really precarious state of sportswear titan Nike.
Yeah, our mission for this deep dive is to understand this staggering paradox. Like, how has one of the most recognizable, culturally embedded brands on the entire planet seen its stock price plummet nearly 49% in a single 52-week period?
Because a wealth destruction event of that magnitude, I mean, that isn't just the result of a bad quarter
Right.
or, slightly missing an earnings target. It represents a fundamental recalibration of how the global market values the entire future of the enterprise.
Yeah, it's massive. And for you listening, I want to reassure you right now, you do not need a finance degree to follow along with us today.
Definitely not.
We are going to extract the why behind all these raw numbers so you can understand the broader mechanics of how legacy retail brands navigate modern crises.
We'll break down the financial reality, the boardroom chaos, all of it.
Yeah, the brutal competitive pressures, all without getting lost in the spreadsheets. So to start, we have to look under the hood at the raw financial trajectory over the last couple of years.
Because the numbers in this equity report are jarring. They really are.
Fiscal 2026 revenue currently sits at $46.39 billion. Now, I know $46 billion sounds like a mountain of cash, but the report places that in context.
Yes, there's a stark decline.
A huge decline from their fiscal 2024 peak, which cleared over $51 billion.
Yeah, and the thing is, the market doesn't reward absolute size. It rewards momentum.
Mm-hmm.
When a growth-oriented company like Nike stops expanding and actually shrinks its top-line revenue by roughly $5 billion over a 2-year window, institutional investors panic.
They absolutely panic.
Because they model these companies with the assumption of perpetual growth. If that stops, the model breaks.
And the bleeding isn't isolated to the top line either. Net income has taken a massive hit, dropping from $5.7 billion in 2024 to just $3.1 billion in 2026.
Wow, so almost half.
Literally. They've essentially watched nearly half their profit evaporate in just 24 months. Profitability is getting squeezed from every direction right now.
Yeah, the report notes their trailing 12-month net margin is sitting at a very concerning 6.7%.
Let's contextualize that net margin for a second, because 6.7% might not mean much to everyone. If I go to the mall and buy a pair of premium basketball shoes for $200, a 6.7% net margin implies Nike is only keeping about $13.40 in actual profit at the end of the day.
That is a brilliant way to frame it, because people think, oh, it's a $200 shoe, they must be making a killing.
Right.
But the raw cost of making the shoe in a factory might be low, sure. But once you layer in global freight logistics, massive marketing budgets.
The athlete endorsement contracts.
Yes, the huge contracts, store leases, corporate overhead, that $200 in revenue shrinks violently before it ever hits the bottom line.
Which brings us to a major catalyst for this 52-week slide. JPMorgan downgraded the stock to underweight in August of 2026.
And they were pretty clear about why.
They explicitly cited Nike's internal turnaround strategy, which is ironically titled Win Now, as the primary reason.
Yeah, Win Now is quite the name for it right now.
Seriously. The analysts stated that the costs associated with this initiative are going to heavily drag down financials all the way through fiscal 2028. Okay, let's unpack this.
Please do.
It feels like Nike is trying to sprint a marathon while wearing a weighted vest. Or it's less like lacing up for a sprint and more like deciding to completely remodel a massive, bustling restaurant while you are still trying to serve customers.
The restaurant remodel is the perfect analogy. Because what's fascinating here is that corporate turnarounds, they require massive upfront capital expenditures that just savage your profit margins in the short term.
Right, you're paying contractors double time to fix the plumbing while half your kitchen is closed.
Exactly. And in Nike's case, win now involves paying out these massive severance packages to reduce headcount. They're breaking leases on underperforming physical stores and completely reorganizing their global supply chain to be more agile.
All of which costs a fortune. And then there's also the inventory liquidation aspect, right?
Oh, yeah. That's huge.
If you're pivoting your strategy to launch fresh, innovative products, you can't have warehouses clogged with last year's shoes. You have to mark them down.
And liquidating old inventory is arguably the most painful part of the process because it hits the brand on two fronts simultaneously.
How so?
Well, first, selling a shoe at a 40% discount completely obliterates that already fragile 6.7% net margin we just talked about.
Right, you're basically selling at break even or even a loss just to generate cash and clear warehouse space.
Exactly.
Yeah.
And second, you're also damaging the brand's premium aura. If consumers get used to seeing the iconic swoosh on the clearance rack at discount retailers,
They become incredibly hesitant to pay full retail price for the new releases next season. Why pay $200 when I can wait and pay $100?
precisely. And you've hit on the exact reason Wall Street hates turnaround phases. The win now strategy is basically forcing investors to endure a lose now reality.
A lose now reality. Wow.
Yeah, because stock prices are forward-looking mechanisms. They represent the present value of all future cash flows.
Right. So when JPMorgan looks at Nike and sees a multi-year cost drag, meaning those profit margins will be compressed through 2028, the mathematical valuation of the company's immediate future simply has to drop.
It has no choice but to drop.
So since internal turnaround costs are cannibalizing margins, my mind immediately goes to the top line. Like, can Nike just out-earn these costs by flooding the market and selling more shoes?
Well, that requires us to look at their external market pressures.
Exactly. This equity research report highlights that Nike's historical moat, meaning its legendary brand equity and massive global scale, is under severe, sustained attack.
And just for context for you listening, an economic moat is the structural advantage that protects a company's profits from being eroded by rivals.
Right, like a moat around a castle.
Exactly. It's what stops a new shoe company from just copying Nike's designs and stealing all their customers overnight. Historically, Nike's moat was this incredible combination of cultural relevance, like everyone wanted to wear what their favorite athlete wore, and unparalleled distribution.
But the report details how that distribution advantage has actually become a liability.
Yeah, which is wild to think about.
There is noted weakness in the Greater China region, which historically was a hyper-growth engine for them. But more importantly, the research highlights a, quote, slow motion unwind attributed to Nike's aggressive shift toward a direct-to-consumer, or D2C, model.
This is such a critical point.
I want to dig into the mechanics of this because for years, the narrative was that cutting out the middleman was the holy grail for retail brands. Like, D2C was everything.
Oh, the theoretical economics of direct-to-consumer are intoxicating for a boardroom.
I bet.
Instead of selling a shoe to a wholesale partner, like, say, Foot Locker for $100 so Foot Locker can sell it to the customer for $200, Nike decided to build its own apps, open its own flagship stores, and just capture that entire $200 directly.
I mean, it sounds foolproof on a spreadsheet, right? You have to keep all the margin.
It does. But the problem is that wholesalers actually provide a massive service that you just don't appreciate until it's gone.
What do you mean?
Well, when Nike sells to Foot Locker, they load 10,000 boxes onto a single pallet, ship it to one distribution center, and receive a massive check. The transaction is done.
So the risk transfers entirely to the wholesaler. If those shoes sit on the shelf, Foot Locker has to deal with the markdown, not Nike.
Exactly. But in a direct-to-consumer model, Nike is suddenly responsible for everything. They have to pay for the targeted Instagram ad to acquire the customer.
Right.
They have to pay the skyrocketing logistics costs to ship one single shoebox to a port in Ohio.
And if that customer decides the shoe doesn't fit and ships it back, Nike absorbs the cost of reverse logistics, which I imagine is astronomically expensive.
It is. It really is. By intentionally unwinding their historical retail relationships to chase those DTC margins, Nike lost the buffer those wholesale partners provided.
Wow.
So when global consumer demand softens, Nike is left holding the bag on millions of units of inventory without their traditional retail network to help clear it out.
Which perfectly sets up a fascinating and honestly somewhat terrifying market event detailed in our sources from August 17th, 2026.
This was a crazy day in the markets.
Yeah, so a competitor, On Holding, they're the Swiss company behind those everywhere you look. On cloud running shoes, they reported weak revenue guidance. And the report notes that On Holdings' weak guidance immediately acted as a lead weight, dragging Nike's shares down to a new 52-week low on that exact same trading day.
That event is just a textbook illustration of sector sentiment and interconnected market mechanics.
Right, but here's where it gets really interesting to me. I can see why an upstart missing its numbers is bad news for the upstart, but Nike is a behemoth.
Right.
Why does the titan of the industry care if a smaller competitor trips? It almost feels counterintuitive. Like, shouldn't Nike stock go up if a rival is struggling?
You'd think so, right? It would go up if on-holding struggle meant Nike was actively winning back market share. But institutional investors interpreted on-holdings' weak guidance entirely differently. They viewed it as the canary in the coal mine for macroeconomic consumer health.
Ah.
If a nimble high-growth brand that has been stealing market share for 3 years is suddenly waving a red flag about softening demand, it signals that the overall appetite for premium athletic footwear is shrinking globally.
So it's not just that On Holding or Hoka are eating Nike's lunch, it's that fewer people are eating lunch altogether.
Exactly. You are looking at a shrinking pie. Consumers are feeling the pinch of inflation, higher interest rates, just general economic uncertainty.
Yeah, they're delaying discretionary purchases like a $180 pair of running shoes.
Right. So for Nike, trying to execute a complex, incredibly expensive internal reorganization while the external winds of consumer demand are blowing aggressively in their face.
It's basically a worst-case scenario.
It really is.
So we have internal costs spiraling from the win now strategy and external demand evaporating as evidenced by the D2C unwind and the on-holding domino effect. This naturally forces us to look at how the market and Nike's own boardroom are actively reacting to this pressure cooker.
And it is not pretty.
No, the technical breakdown in the report is brutal. As of August 17, the stock closed at $39.09. That is sitting roughly 51% below its 52-week high of $80.17.
The stock has literally been cut in half, which triggers a host of algorithmic and psychological selling pressures.
The report specifically notes the price is trading well below its 20-day, 50-day, and 200-day moving averages. I want to unpack what that actually means mechanically because we hear those terms thrown around constantly on financial news.
Sure, so a moving average is simply a line on a chart that smooths out daily price fluctuations to show the underlying trend over a specific period. The 200-day moving average is arguably the most important psychological benchmark for institutional computers and human traders alike. It represents the average price investors have been willing to pay over the last 10 months.
So when a stock crosses below that 200-day line and stays there, it's not just a mathematical curiosity, it's the market's collective psychology shifting from optimism to pessimism.
Yes, it is the market actively declaring the long-term trend is broken. The buyers who are propping up the price are exhausted, and the sellers are in complete control.
Wow.
Institutional algorithms are programmed to treat stocks trading below their 200-day moving average as damaged assets. They often automatically trim their positions, which creates this vicious, self-fulfilling cycle of downward pressure.
And amidst all this technical carnage, there is massive leadership turnover happening in the C-suite. A new chief financial officer, David M. Denton, just took over on August 16th.
Right.
And the chief accounting officer, Johanna Nielsen, is resigning effective September 4. So what does this all mean for you as an observer?
Looking at the timeline, my alarm bells are ringing. Oh, they should be.
A new CFO arrives right as the stock hits a multi-year low, and the head accountant walks out the door 2 weeks later. This looks like a classic kitchen sink scenario.
The execution risk here is immense, and the timing of the chief accounting officer's departure is particularly sensitive.
Explain the kitchen sink mechanic for us, because it feels like a strategic move disguised as a crisis.
It kind of is. When a new executive team comes in, especially a CFO who's directly responsible for the numbers, it is entirely in their best interest to reset Wall Street's expectations as low as humanly possible.
Right.
You throw every piece of bad news, every write-down, and every restructuring cost into the kitchen sink for your first earnings report. You just blame the old management regime for the mess.
You essentially dig the hole as deep as possible so that any minor improvement in the next quarter looks like you are a genius orchestrating a miraculous recovery.
Precisely. But executing a kitchen sink quarter requires very creative accounting regarding how you categorize certain losses and timeline your expenses.
And having your chief accounting officer resign 2 weeks after the new CFO arrives.
Exactly. It suggests, at minimum, a massive disruption in the financial reporting chain. and at worst, a disagreement on how these numbers are actually being framed.
And institutional investors despise uncertainty more than they despise bad news.
Oh, absolutely. Bad news can be modeled. If you tell an analyst revenue will drop 10%, they can put that into a spreadsheet, run a discounted cash flow analysis, and arrive at a fair stock price.
But uncertainty.
Uncertainty means the inputs for the spreadsheet are totally unknown. It renders their financial models useless. And when investors can't model the future, their default reaction is to sell the stock and ask questions later, which cements the current heavy bearish sentiment.
Which brings us to the final and frankly the most critical piece of the puzzle. Having mapped out all this financial damage, the competitive threats eroding their moat, and the boardroom chaos, we have to determine if the broader market has already factored all of this bad news into the current $39 price tag.
This is the exact tension debated daily on trading desks regarding legacy brands. Are we looking at a stock that is fully priced in, or is this a classic value trap?
Let's lay out the bull case first, the priced-in argument. The stock is down 49% in 52 weeks. The valuation multiples have compressed significantly. The price-to-earnings, or PE ratio, is sitting around 19.4. Historically, Nike has commanded a much higher premium.
Yeah, much higher.
Our sources even highlight a contrarian, bullish opinion piece from a Seeking Alpha contributor who is buying the stock now after avoiding it for 6 years.
So, to understand the bull case, you have to look at the mechanics of multiple compression.
Okay.
The PE ratio is simply how much an investor is willing to pay for $1 of a company's profit. For the last decade, investors routinely paid $30 to $40 for every single dollar of Nike's earnings because they believed that dollar would rapidly grow into $2.
But now they're only willing to pay $19 for that same dollar of earnings. The growth premium has been completely drained out of the stock. It's like looking at a classic vintage car on sale for half its usual price. You have to ask yourself, does it just need a tune-up and some fresh paint, or does it have a fundamentally cracked engine block?
And the bulls are betting it just needs a tune-up. They look at the balance sheet, which still holds over $7.5 billion in cash.
That's a lot of cash.
It is. They argue that despite the stumbles, the Nike swoosh remains one of the most recognizable logos in human history. The expectations are so incredibly low right now that the downside risk is limited.
But the report is very clear on the bear case and the risks of a value trap. What if the bad news isn't actually finished?
A value trap occurs when a stock looks cheap based on historical valuation metrics, but the underlying business is deteriorating so fast that the stock is actually still expensive.
If we look back at those win-now turnaround costs, JPMorgan warned those could linger through 2028. If those costs stay elevated, or if the on-holding guidance was just a preview of deeper consumer weakness, Nike's overall earnings could continue to drop.
And here is the trapdoor mechanism.
Let's hear it.
If earnings continue to fall, that $39 stock price has to drop even further just to maintain that seemingly cheap 19.4 PE ratio.
Right.
If they lose mindshare among younger consumers who really dictate the future of athletic apparel, that 19 multiple might not be a bargain at all. It might be the new permanent ceiling for a brand that is transitioning from a growth story to a mature, slow-moving utility.
So when does the market actually force a resolution between these two viewpoints? The sources point to an immediate catalyst. The Q1 fiscal 2027 earnings report is confirmed for September 24 to 2026.
That's the big day.
This is the moment the market will test Nike's previous guidance, which management previously described as flattish for Q2.
September 24 is the ultimate proving ground. The overall rating from the equity research report is neutral, which perfectly reflects the stalemate between the bulls and bears. If the new CFO steps up to the microphone on that earnings call and issues guidance that is worse than flattish, if they execute a massive, brutal kitchen sink dump of bad news and write-downs of the floor could completely drop out, we could see those long-term technical support levels shatter entirely.
But if they can hold the line, if they maintain that flattish guidance and signal that the worst of the win-now capital expenditures are finally peaking,
then the narrative shifts. The market doesn't need Nike to be perfect on September 24. It just needs to see a credible light at the end of the tunnel.
Right.
If costs show signs of subsiding, the massive institutional money sitting on the sidelines might finally decide the risk-to-reward ratio is favorable enough to start buying the turnaround.
This has been a genuinely eye-opening journey through the mechanics of corporate crisis. Let's briefly recap what we've unpacked today. Nike is currently a severely derated franchise. They possess a fortress of a balance sheet with billions in cash, but they are wrestling with a multi-quarter cost overhang driven by their own win-now turnaround strategy.
Yeah, the costs are heavy.
They are facing a shrinking economic moat due to a bungled direct-to-consumer shift, softening global demand in key markets. And they are attempting to navigate all of this with poorly timed, highly uncertain leadership transitions in their financial C-suite.
For anyone tracking investments or just studying business, this scenario is an absolute masterclass in market dynamics.
Truly.
It illustrates with ruthless clarity how quickly a wide economic moat can evaporate when internal corporate strategy and external consumer trends fall out of alignment. No brand, regardless of its historical dominance, is immune to the laws of financial gravity.
Which brings us right back to that stumbling sprinter we talked about at the top of the show. As you digest all this information, I want to leave you with a final thought to ponder on your own.
I love this part.
Consider the concept of brand elasticity. We know a behemoth like Nike has the capital to bounce back from a bad quarter or a logistical misstep. But how much structural damage, inventory liquidation, and loss of cultural cachet can a legacy company sustain before its iconic logo permanently loses its premium pricing power in the minds of the next generation of consumers?
That's a great question.
Can a brand stretch forever, or does it eventually snap? Something to think about. Until next time, thanks for taking the deep dive with us.